Welcome to the Deep Dive, your shortcut to getting up to speed on the market's most interesting stories. Today we're diving deep into the recent Q4 fiscal 2025 earnings call for Kestra Medical Technologies, that's KMTS. This is a company really on the front lines of cardiac recovery. They focus on connected, wearable defibrillators for patients, after a heart attack. Our goal here is to cut through the noise, pull out the key insights from their latest update, and help you quickly understand what really matters for this growing medtech innovator.
Yeah, in Kestra Medical's Q4 numbers, they tell a pretty classic growth story, but with a twist. You've got this explosive top-line success, but then there's this widening bottom-line challenge. On revenue, they absolutely shattered expectations, pulled in $17.2 million.
Wow.
Yeah, that's a staggering 71% jump year over year. Really impressive, beating the consensus estimate of $15.7 million. And this growth wasn't just a fluke. It was driven by 3,903 Assure system prescriptions. So that's pretty clear validation their product is gaining traction.
Okay, that top-line momentum sounds fantastic, doesn't it? But here's where it gets, maybe a bit more complicated. While that revenue ramp definitely got people excited at first, the official GAAP loss, it widened pretty substantially. Came in at $2.99 per share.
Oof.
Yeah, and that's a big miss compared to the -56 estimate analysts were looking for. So what we're seeing is that initial excitement for the growth, it sort of faded fast once that deeper than expected loss hit the headlines. It signals some broader concerns the market's kind of wrestling with.
Indeed. And let's unpack those financials a bit more, because there's a really fascinating story sort of buried in the numbers. A huge highlight was the jump in gross margin. It soared to 44.3% in Q4.
44%.
Yeah, which is a massive improvement from just 13.9% in the prior year. And for the whole fiscal year 2025, the gross margin hit 40.5%. Compare that to fiscal 24, where it was barely above water at 1.3%. This isn't just, small steps.
Yeah.
It's a really dramatic shift in their profitability profile, fundamentally.
That is a massive jump. So what's driving that kind of dramatic improvement in their gross margins? What's the secret sauce there?
Well, management points mainly to a richer in-network patient mix. Basically, they've inked more deals with insurance providers. So a higher percentage of their patients are now covered by these direct agreements. That usually means more predictable and often higher reimbursement per fitting. Combine that with, the efficiencies you get from just doing more volume, increased scale.
Makes sense.
And they sound really confident about reaching over 70% gross margin in the next few years, which, for a device company, that's incredibly aggressive, an impressive target. If they hit it, it really speaks to the long-term potential they see in the business model.
Okay, so if gross margins are looking so much healthier, showing a better underlying business, why are we seeing that overall loss get wider? Is this just, smart strategic investment for growth down the road? Or are there maybe some inefficiencies we should be worried about?
That really is the core tension, isn't it? Despite the great revenue growth and those improving gross margins, their GAAP operating expenses were, hefty. $55.8 million in Q4. Now, that number includes $22.3 million in stock-based compensation, which, it's non-cash, but it still hits the reported earnings, and another $3.8 million tied to IPO stuff, professional services.
Right.
But even if you pull those specific items out, operating expenses still jump to $29.7 million. And that's mostly because they're hiring more people for their commercial team and for revenue cycle management. And they flagged about $40 million in stock-based comp expected for fiscal 26. So that's, an ongoing factor to keep in mind. And their adjusted EBITDA loss, which kind of strips out some of those non-cash things to give a clearer operational picture, it still widened to minus $20.3 million in Q4. So yeah, continued heavy investment in growth.
So, it's clear these investments are definitely eating into profits right now. But the big question for investors is, how long can they keep this up? What about their runway? Well, looking at their balance sheet, Kestra still holds a healthy amount of cash and cash equivalents. $237.6 million as of April 30th, 2025. That certainly gives them some breathing room to execute the strategy.
Exactly. And this heavy spending isn't just random, right? It's directly linked to management's strategic priorities. Let's dig into what they're actually focusing on. Kestra really emphasized making continued progress in what they call revenue cycle management, or RCM. That's basically the whole process of how they get paid.
Usual.
Yeah. And also expanding their in-network payer coverage. They now cover over 285 million health plan members in the U.S. That's a big number.
That is a critical point. And they highlighted something significant, signing a sole source contract with a risk-bearing provider network. That's basically a really powerful endorsement, isn't it?
Yeah.
It signals strong recognition that the Assure system has some real differentiated benefits.
Yeah, absolutely.
This kind of sole source deal, it's a strong vote of confidence. And practically, it helps streamline things like prior authorizations. That makes the whole revenue cycle more efficient and, importantly, makes it easier for patients to actually get the device.
And they're also aggressively, and I mean aggressively, expanding their sales organization. They hit about 80 sales territories by the end of fiscal 25.
Wow, 80?
Yeah, that's a huge 67% increase year over year. And their focus is strategic, hitting those geographies with high WCD, wearable cardioverter defibrillator prescriptions, and where they have strong in-network coverage. The plan is to nearly double sales coverage over the next few years. So a very aggressive push to grab market share.
And beyond just hiring salespeople, they're not sitting still on the product side either, right?
Yeah.
Kestra mentioned having over 365 patent assets. That speaks to their IP moat. And they're working on what they called exciting projects to extend the Assure system's clinical edge and even introduce some first-in-category new therapeutic capabilities. Sounds intriguing.
Yeah, it does. And
they back this up with some compelling real-world data from like over 20,000 patients, showcasing really impressive results like a 96% first shock success rate.
That's very high.
And an extremely low false alarm rate, just 6%, which, they pointed out, compares really favorably to a competitor's reported rate of like 46%.
Big difference.
Huge difference. And they also noted high patient compliance, patients wearing it at a median of 23.2 hours a day. That really says a lot about the patient experience, the comfort of the device.
And this all leads into the bigger picture, the broader market opportunity, which is frankly massive. And it's where Kestra sees potential that goes way beyond just stealing market share from others.
Management kept highlighting how underutilized WCD therapy is right now. It reaches only about 14% of the eligible U.S. patient population. We're talking 850,000 people annually who could potentially benefit.
Only 14%, that's low. It is, and they believe their Assure system, purpose-built for comfort, compliance, fewer false alarms, directly tackles the limitations of the older incumbent devices. So the idea is this enables market expansion, not just market share conversion. They're not just trying to get existing WCD users to switch. They're trying to grow the whole pie, reach patients who currently aren't getting any WCD therapy.
And they actually gave a really powerful example of this market expansion idea in action. They talked about 2 regional hospitals that, after adopting Kestra's approach, basically went from barely using WCDs to actively setting up protocols for them.
Right.
And this led to a big jump in patients using the Assure system, many of whom they said would have previously just gone unprotected. So it's not just about fighting for existing customers. It's about genuinely creating a market, getting this life-saving tech to people who otherwise wouldn't have it. That really underscores the potential impact here.
Absolutely. And finally, let's touch on their guidance for fiscal year 2026. Management actually raised its revenue outlook to $85 million. That represents a pretty robust 42% year-over-year increase.
Solid growth projection.
Yeah, and they expect this growth to come from, faster Assure adoption, getting a bigger share of business from existing customers, signing up new accounts, and just continuing to improve that RCM process and the in-network patient mix. They also anticipate significant operating leverage, meaning, as revenue climbs, their profits should theoretically grow even faster because a chunk of their costs, like R&D or fixed overhead, don't scale up directly with every single new sale.
Okay, so that's the company's story. Now let's shift to the market's immediate reaction. Yeah. The stock closed down 7.3% on the day after earnings, on almost 4 times the average trading volume. That pretty clearly signals that the big EPS miss, despite the revenue beat and the raised guidance, it really weighed heavily on how investors felt.
Yeah, it definitely did.
It suggests this broader concern about the immediate path to profitability. Like, how quickly will all these significant investments in operating expenses actually start showing up as a stronger bottom line?
And what's interesting here, too, is you saw this kind of sympathy sell-off in other small-cap medtech stocks. That suggests maybe a broader risk-off feeling in the sector right now, especially hitting companies that have negative earnings. So for you, the investor looking at this, the core tension is really clear. You've got robust top-line growth, really impressive gross margin expansion starting to show. But that's set against these widening losses driven by major operational investments.
Right.
The company's actively using its IPO cash to scale up grab share in this big underpenetrated market. The question really becomes, how long is the market willing to stomach these losses for that future growth? And, when will that operating leverage they talk about actually start hitting the net income line?
So, practically speaking, what should you be watching for as this story develops?
Well, keep an eye on continued improvements in their revenue conversion rate. Kestra sees that as a big opportunity, aiming to close the gap towards what they call a best-in-class rate of 76%.
That's a key metric.
Definitely. Also, closely watch prescription growth, obviously, and the balance between how fast they're expanding sales territories versus how productive those territories actually are. Successfully integrating and ramping up those new sales teams will be absolutely crucial if they want to hit that aggressive revenue guidance they put out.
Makes sense.
All right, let's put on our speculative hedge fund analyst hats for a moment. Time for our This Is Not Financial Advice segment. Looking at Kestra Medical, it's undeniably a growth story, right? Clear operational momentum, massive untapped market. But the market is just clearly punishing that near-term profit picture right now. Okay, so here's let's call it a wild yet plausible idea, maybe for the bullish side. Given how the stock slid after earnings and its history of being pretty volatile, you could think about a multi-part approach. Maybe initiate a long equity position, so buy the stock, but then strategically finance part of that cost by selling out-of-the-money put options. So options with a strike price below where the stock fell after earnings.
Okay, so selling puts.
Right. The idea here is that the market's initial freakout over the EPS miss might have set a near-term floor, and the premium you collect from selling those puts gives you immediate income. You're essentially getting paid to bet against more significant downside from here. It signals conviction in the long-term story, that path to 70% plus gross margins, the market expansion strategy. You're basically saying, I'm willing to buy more if it dips further.
Interesting. Okay. Conversely, what about a shorter term, maybe more speculative play for those who think the market's going to stay focused on the losses for a while?
Well, for that perspective, you might consider a bearish options strategy. Something like buying a put spread that expires in, say, a few months. This involves buying one put option and simultaneously selling another put option at an even lower strike price.
Right, defining your risk.
Exactly. The goal is to capitalize if confidence erodes further, maybe if the next update doesn't show clearer progress on narrowing those losses. But it also limits your potential downside compared to just shorting the stock outright. It's a defined risk way to bet on more near-term pressure. Okay, so let's recap the main points here. Kestra Medical Technologies, they presented a quarter with strong revenue growth and really significant gross margin expansion. This was driven by more doctors prescribing the Assure system and their strategic moves to penetrate the market. They've laid out some aggressive growth plans for fiscal year 26, and they're backing that up with substantial investment in their sales team, R&D, and getting that payment process, the RCM, working better.
However, and it's a big however, these investments are hitting near-term profitability. That led to a pretty pronounced earnings miss that, well, the market reacted to pretty decisively. Which brings us to maybe the bigger question here. In this world of medtech, where exactly is the right balance? How do you weigh investing heavily now to capture a huge market opportunity versus delivering profits in the near term?
Yeah, it's the classic growth versus profit debate.
For Kestra, it seems the journey to becoming the standard of care for these patients at risk of sudden cardiac arrest. They're clearly prioritizing that aggressive market capture right now. So the fascinating thing to ponder is, how long will investors keep prioritizing that long-term vision, becoming the standard of care over those shorter-term financial metrics like profitability? That's definitely something to think about as you watch this space.
Absolutely. And just a reminder, the information we talked about today is purely for informational purposes. It is definitely not financial advice.
That's right. As always, please do your own research, your own due diligence before making any investment decisions.
We really hope this deep dive into Kestra's earnings call has given you some valuable insights. Thanks for tuning in.
Until next time, stay well informed and keep asking those insightful questions.